So I sit across from millionaires pretty much every single week. It's my job. I'm an independent financial advisor in the UK, and I get the absolute privilege of being able to look under the bonnet of how wealthy people actually handle their money. And here's the thing that surprises me the most. The difference between the people with serious wealth and everybody else. It's not intelligence. It's not some fancy background. It's often not even luck. I am going to show you how the 1% actually makes and handles their money. And stick with me, because once you see how the top 1% actually manage their money day to day, you're going to look at your own finances in a completely different way. And honestly, you can start doing this today, regardless of what you earn. We're talking about the difference between retiring comfortably and working until you are 70. After sitting across from hundreds of clients over 15 years, I genuinely started to notice something. The ones who were actually building serious wealth, I'm not talking just about necessarily like high earners. I mean, people who are genuinely getting and are rich, they all thought the exact same way about money. It wasn't how much they earned. Some of my wealthiest clients started on completely ordinary salaries. What separated them was how they actually ran their finances. Every single one of them, they knew the numbers, right? They knew exactly what was coming in, what was going out, and where every spare pound and penny was being put to work. They had a system and they knew it. And at some point I realized it's not just like managing money. What they're actually all doing is they're running a business. The business is their life, and they are the CEO of it. And I started calling it UPLC. Now, before you think, oh God, okay, this all sounds a bit corporate and boring, hear me out. Because this one shift in the way that you view your money is the foundation of how the 1% actually manage their money. It's how they pay less tax. It's how they keep more of their income. It's how they build wealth on autopilot. And once you get it, everything else clicks into place. So, if you are the CEO of UPLC, the first thing that you look at, or the first thing you should be looking at, is how much money comes into your business versus how much goes out. Now, there's an old saying in business, you've probably heard of this before. Revenue is vanity, profit is sanity. Basically, what that means is what you earn means nothing. So a business earns £1 million, it means nothing. What actually matters is what you keep. What you keep is everything, okay? And yet, what do most people obsess over? Well, their salary, the big number on the job offer before taxes take its cut. I always remember I had this client come into my office who was dead chuffed because they'd just got a higher salary. And I was like, okay, let's have a look at how that is impacting your overall money and your cash flow and all that sort of stuff. And I was like, okay, what does that look like on a take-home pay basis? And he stared at me very, very blankly. After income tax, national insurance, and he had a big student loan outstanding, so that was taking a little bit more of it. It barely changed anything because he'd moved into a new tax bracket. He was looking at this whole thing through the wrong lens. Now, here's what the 1% do differently. And this is the first piece of how they actually manage money. Fair warning though, this next bit sounds boring, I know, but it's literally worth thousands of pounds to you. So stay with me for the next 30 seconds. So I had two clients who were kind of roughly earning about the same, about £80,000 in salary. One of them did basically nothing and took home about £57,000. The other one told her employer to put part of her salary straight into her pension before the tax man could actually touch it. It's called salary sacrifice. Now, it sounds dramatic, but all it means is that monies go into your pension before tax is taken out. That alone saved her thousands. And on top of that, she also maxed out her ISA, which is basically just a legal tax shelter sitting right here in the UK that not that many people max out. So if we add all of that up, the tax that she saved on her pension, plus the money growing in her ISA, she was keeping about £8,000 more of the same salary than the other guy. £8,000 a year. Over 10 years, that's £80,000 just from knowing where to send your money first. It is not about earning more. It's about keeping more of what you earn. That is the CEO mindset. It's the same way as looking at revenue of a business versus profit of any business. Now, quick thing, if you're finding this useful, I send out a free weekly email where I share the exact strategies that I've learned from helping people build wealth over the years, stuff that I can't even always put in a video. Links in the description if you want in. Now, here's what I see constantly. Someone learns all the tax stuff, salary sacrifice, ISAs, all of that, and they think they've cracked it. But there's a sneakier problem waiting for them. And honestly, this is the trap that catches almost everyone out. Think about what happens when most people get a pay rise. What do? Right? They upgrade their car. They move to a nicer flat. They start eating out more. They get a new phone on contract. Before you know it, they're spending every penny on extra income. It happens all the time. I had a couple whose combined income went from like 60 grand to 90,000 over like 3 years. And I'm not kidding. When they came to see me, they had less in savings than when they started. They were earning 50% more, but keeping nothing extra and even eating into their savings. Their lifestyle had just inflated to swallow every single penny. The 1%, they do the exact opposite. They keep their fixed costs of the business as stagnant as they possibly can. When their income goes up, they keep their living costs roughly the same to increase that gap. That extra money, it goes straight into the bottom line. It's pure profit. Even just keeping your spending flat after a £5,000 pay rise means an extra £50,000 over 10 years before any investment growth. That's a deposit on your house just from not upgrading your lifestyle. Now, again, people always say, oh, I can't always do this, blah, 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 blah. I'm not saying live like a monk. That's miserable and nobody sticks with it. But here's a number that should honestly wake you up. The cost of living in the UK, food, energy, rent, has gone up by over 30% before COVID, essentially, from before COVID. If your salary, and your salary certainly has not kept pace with that, the gap, that is your missing profit. That's the difference between building wealth and just running in place. This is the second piece of how the 1% actually manage their money. They protect that profit margin like their life depends on it. And this is all still just mechanical stuff, right? The real difference, the emotional part, that's coming. And it's the bit that changes everything. All right, so you got your CEO hat on, essentially. You've got your profit margin sorted. You're keeping more every single month. And this is exactly where most people destroy everything they've just built. Because what you actually do with that profit, that is where the real money is made, or more likely lost. And it comes down to literally one simple question. Are you buying assets or are you buying liabilities? Here is the simplest way to think about all of this. An asset puts money in your pocket. A liability takes it out. That is it. So you'll probably be a bit annoyed that I've used him as an example, but we'll go with it. So I had a mate, and you probably know if you're watching, I had a mate who bought a brand new BMW 5 Series on PCP, on finance essentially, 40 grand-ish, but he loved it. Parked it on his driveway like it was some sort of trophy. 3 years later, he tried to sell it, worth about 22 grand. When you add up the interest that he'd probably paid around £42,000 for that, for something that's now worth 22. That is not an asset, and he will freely admit that. That is a money bonfire, and he's not unusual. Most people's driveways are full of stuff that is just bleeding them dry. Now, the 1%, and this is where this gets good, they use their monthly profits, the profit margin, to buy things that actually grow in value or produce an income. We're talking about investing, right? Stocks, bonds, properties, things that grow in value while you sleep. You're basically building your own little empire, using leftover money each month to buy little money-making machines. And here's the mad bit. If you put just £500 a month into a diversified investment portfolio with heavy stock market exposure starting at 25, by the time that you are 55, you'd be sitting at roughly £500,000. That is a snowball. And the earlier you start rolling, the bigger it gets. But here's what surprised me. The smallest investor, the smartest investors I work with, their best performing asset, well, it wasn't any of their investments at all. It wasn't the stock market at all. I had a client who spent £3,000 on a bit of paper. Her husband thought she was absolutely mad. £3,000 just gone. But it was on a professional certification. Now, do you know what happened? Within 18 months, she had moved into a new job role paying £20,000 more. That £3,000 is now generating £20,000 annually. No stock market returns on earth can give you that sort of return. It's the same reason that Apple and Microsoft pour billions into research and development every single year. They're not doing that for fun. They're buying future revenue. They're buying value. The 1%, they do exactly the same thing with their own skills. Courses, qualifications, coaching, anything that can add value and make them more valuable. Think about it. When was the last time that you actually spent money learning anything that could actually use to leverage to get a pay rise or earn more money? Most people will drop £2,000 on a holiday without blinking, but they won't invest £2,000 on a course that can earn them an extra £10,000 a year. And the thing is, you don't even need £3,000. A £500 online course, the right book, or even a free YouTube tutorial on things like negotiation or investing or whatever, it all compounds. The 1% just never stop investing in things that earn them money themselves. This is the bit that most people just never think about. The 1%, with their businesses, they reinvest the profits into both the market and themselves. They're building the business and upgrading the CEO at the same time. So you've got the business running, money's coming in, costs are lean, you're buying the right things, you're investing in yourself. Now, all of that sounds bulletproof, right? It's not. The thing that will wreck all of that overnight, it's got nothing to do with money and it's got everything to do with your brain. Now, picture this. You're the CEO of a company. The economy dips and one quarterly report comes in a little bit rough. Do you immediately sell off all your factories and fire everyone? Of course you don't. You'd get sacked on the spot anyway for being reckless. That's exactly, though, what millions of people do with their investment. If the stock market drops 10% because of some crazy headline, could be a war, could be a trade dispute, whatever, they will panic, sell everything. Think about this. March 2020, COVID, for example, the stock market crash of COVID. The S&P 500, essentially a proxy for the wider stock market, dropped by 34% in 5 weeks. Millions of investors, many of my clients did exactly the same, and I spent hours on the phone and via email telling them not to, begging them, sold at the bottom. And guess what? Then the market bounced back within 5 months, a full recovery, one of the fastest recoveries in history. And the people who sold, they turned a temporary dip into a permanent loss. Too scared to buy back in at a higher price. So ask yourself this. If the markets dropped by 20% tomorrow, what would you do? Honestly, I'm interested. And really think about it. Drop your answer in the comments. I read every single one, because that answer tells you everything about whether you'd actually build wealth or destroy it. Now, the 1%, what do? Well, when the market drops, they don't panic. They actually get a bit excited. I see this all the time, because they see it like a massive sale. Imagine your favorite shop had 20% off. You'd be absolutely buzzing. That is exactly the same thing. The people who kept investing more fresh money during those drops, their portfolios are up over 25%, or were up 25% within a year. They got paid for just keeping their cool. Now, they stick to the plan. They ignore the noise. They let the strategies play out over decades, not days. That discipline, treating your finances like a business, not a feeling, is a huge piece of how the 1% manage their money. I have got clients right now, ordinary salaries, nothing flashy, who are on track to retire in their early 50s in that top 1%, not because they earned any more than me or you, but because they ran their life like a CEO and their money like a business. But everything I just showed you changes depending on what you actually earn, which is why you should watch this video here next. Because if you get this wrong, it will cost you. If you're on 30 grand doing the same strategy as someone on 100,000, you're going to lose money. If you're on 100 grand doing the same thing as 30,000 pounds, you're leaving tens of thousands of pounds on the table every year. I'm going to break down exactly what to do at your specific income level. So give it a click and I'll see you there.